Hi everyone, I hope you're all doing well, and today I'm going to be doing a stock video that's a little bit different from normal. I'm not actually going to be covering any stocks. I'm going to be giving out some investing tips, some useful advice about how to get a 100% return on a stock. So for that, guys, smash the like button. I think this could be one of the longest videos on the channel. I don't know, at the start of the video I don't know exactly how long we'll go on for, but I feel like to cover all this I was spending quite a bit of time, so we'll see how well we do. I'm also not going to be putting any information onto the video screen today. It's just all going to be on me and using the whiteboard today, because like I say, I don't really need any pop-ups on here. It's just kind of a little bit of advice about how to pick some really amazing stocks. And just for that, like I say, if you can smash that like button, it'd be absolutely amazing. And in the link description below, there's the patrons group, there's Discord group. On there I'm always posting stocks that I'm looking at buying, which there are certain stocks that I believe could make a 100% return. So we'll get stuck onto the video today and talking about how to get a 100% return onto the stock market. Now, a lot of you guys asked that if I could do a bit more information of like useful information about how to make bigger returns, how to look into stocks, make more videos more often about them sort of topics. So today is one of those videos. So yeah, talking about how to get a 100% return from a stock. And what I felt like is when I invested into the stock market, or started to invest in the stock market, which was maybe 3-4 years ago now, there wasn't that much useful information out there in on the internet, especially from the UK side of it. There wasn't really many UK investors. There's still not now, but they're starting to get a little bit more. And YouTube wasn't really a thing. It was only just starting up with the stock market community as well. So there wasn't many videos out there to help you. And now there's a lot more, which is really good. But I wanted to make a video that if I was back when I was starting my investing career in like 2016, I wanted to make a video that if I watched this video, it would save me so much time, give me so much information, and help me on my journey a lot quicker. And hopefully this video today is going to be that video that I needed 4 years ago now. So that's kind of my aim. So I hope that you do take a few things away from the video. And like I said, I'm going to be putting a lot of things I've learned over the last 4 years of investing into this video to try and help you guys, especially some of you newer guys that are out there on watching me right now, because I know there's some of you guys out there. So to start with, we'll start off at the start, and we'll kind of build it up from here. So to start with, obviously 100% return is a big number, and the reason why I chose 100% return is that's my principle, is like my investing philosophy. Probably you guys, if you're not a lot newer, you might not have one. If you've been in the market a lot longer, you probably have started to build up your philosophy now of certain criteria that stocks need to meet. And for me, if I'm investing to a company, I want to see 100% return from them. Sometimes it doesn't have to be 100% return. If it's something that's an easy money stock, and I think it might not be 100%, but that stock's definitely going to go up from these stock prices, I probably would buy it if it was really easy money. But as a general rule, I tend to go for stocks with 100% return. And obviously I'm looking, as a long-term investor, I'm looking to make this over 2 to 5 years. Now, I think, in my opinion, 100% returns are the best way to do the stock market, because you do take some risk on, but the reward is massive at 100% return. There's other ways that you can invest into the stock market. Obviously, you've got the dividend side of it, and I am a fan of dividends, but not solely dividends. If you do dividends, there's no way you can basically increase your money massively. When you talk about getting 100% return in the stock market, and you do that over the course of 5-10 years, it's very easy for you guys to get from the £1,000 to £10,000 to £100,000 and build up your wealth, to build it up very quickly, and really maximize your wealth. If you've got £10,000 or even less than that, and you put it into dividend stocks solely for the dividend, and the share price goes down, you get slaughtered. Even on dividend stocks, if you buy dividends just for dividends and the share price goes down, it wipes your dividends out. So that's why I always like getting stocks with big massive share price increases. And the thing is, if you put in 5,000 into dividend stocks, what are you going to achieve at the end of the year? You're going to pick up what, £10 in dividends, £15 in dividends, and what's that going to get you? Is that going to just get you a free Nando's once every year? And for me, that's not how. If you want to really maximize your potential in the stock market, I think investing in companies where you're going to get share appreciation, whether it be value stocks or growth stocks, both of them. You can get 100% returns from value stocks and growth stocks. That's where the maximum thing is to get the maximum return. So for me, the best way to increase your wealth, especially through the stock market, is by going through these 100% return stocks. And like I say, in general, you're probably not actually, you might not get them all right. My aim is to roughly get probably 9 out of 10 right, maybe even 8 out of 10. If I can get 8 out of 10, that's fantastic. And like I say, if I do this over a 2 to 5 year period, you do really well and you get a really nice annual return. Something that you won't be able to get into anything else. There's not many other things out there that you can put your money in and get a 100% return on. You put it in your bank, you get 0.00001% return. If you put it into a property, you get what, a 5% yield off your tenant. And you also have to have massive amounts of money to get into the property market. The stock market is really easy to build up your wealth if you can do it right. And obviously, the longer you do it, the better you'll get at it. When you start off, you will make a few mistakes, and obviously you'll learn as you go on. And trying to spot these companies where you get 100% return will come easier the longer you do it, because you'll just see a lot of key signs and you'll learn from the mistakes you did have on previous companies that did go wrong. So yeah, to start off with, 100% return, in my opinion, is the best way to do it, and the best way that you can maximize your wealth. And there's not many other industries where you'll be able to get 100% return from the stock for anything, from investing. So just to start off with, obviously those are the positives of getting 100% return, really maximizing your wealth, which can be done. I've done it previously on a lot of stocks in the stock market. JD, Microsoft, Square, Ferrari, Win Resorts. Those are the ones that come on top of my head. There's probably been a few more. I mean, Boohoo made 85% off Boohoo at the start of the year. Win Resorts made 80% again off it at the start of this year. So there's two that have nearly done 100% returns already this year, and obviously Tesla was this year as well. So I've done it a few times with quite a few stocks, and like I said, this is where I'll go through it. So obviously, to start with, picking your stock is probably or finding your stock is one of the things that you have to do to start with. And obviously finding the stock can be quite difficult, and there's not many great opportunities out there in general. If there were so many great opportunities out there, you would just be putting your money everywhere, and that's not how you're going to do it. There's only a few opportunities out there where you'll be able to get them sort of returns, and you have to go through quite a few companies. You'll have to go through quite a few earnings reports, and like I say, at some point you'll get quicker at doing these. Like if someone gave me a list of 10 companies, and if I had to then look for or short down 2 companies that I wanted to go into a little bit more detail on out of these 10 companies, I could do that within probably 15 minutes. And I can do it a lot quicker now. When I started, it would take me a lot longer. I'd probably be spending 15 minutes on each company. So shorting the companies will get a lot quicker, and finding the companies is tricky. You can listen to a lot of things, but you got to be really careful, because sometimes people are pushing their own agenda on it because they've got an interest in the stock itself. So trying to find a neutral view on a company is very hard. But obviously you've got loads of articles, you've got the news. Obviously YouTube's a really good thing. I'm in a good position where I get a lot of subscribers posting a lot of comments, and I can search through a lot of those companies. So I get a lot of companies that way. Obviously there's a lot of rubbish companies that get posted. I hope I didn't offend anyone there. But at the same time, there's a few gems that do get posted. Like I think was actually one post from a subscriber. So yeah, there's sometimes some gems. So you've kind of got to find a company to look into first. So you want to be, first of all, looking into the company. After you have the first look into the company, and you think this is okay, I'll have a look into this one a little bit more. You're going to have to get a brief understanding of the company, how the company operates. In my opinion, the best way to do it is to go on Google, get an understanding of the company, share price history, how long has it been on the market for, what's the 52-week high, has it traded higher in 2018, 2017, and so on, where's the stock now, and you kind of have a good feel about where the stock's been going. You know, you can look at, is the stock now at all-time highs, and some people say to me, like, you know, do you buy stocks at all-time highs? And if I see 100% return, I can do. And not often I do. Not often I find a stock at 52 high and I think this is a 100% return company. If I do, quite often I put it on my watch list and I wait for the stock to drop and then I'll buy it at least at some sort of a 10-20% discount. So I don't normally buy it at 52 highs unless I see something really amazing, then I potentially could. But it's a big rarity. But yeah, you're going to probably see what's going on with the history, and then depending on what the stock movements are, if it's dropped loads, you can probably search, so it dropped on the 17th of June 2018. Quick type into Google, you probably get some sort of article on it, and it'll say why the stock dropped. So from stock chart you can learn quite a lot of what's going on with the company, where it's at. Also on when you search these companies, especially I like to use the Google one, you'll probably get a P, and if there's no P there, you probably know it's an unprofitable company. And also when the P comes up, it'll say whatever number it is. If it's 10, you probably guess that it's probably a value play. If it's something at 100, it's probably a growth play. And so you can learn a lot from just that P as well. As well as that, you see dividend, you'll see what yield it is. If it's a high dividend, you're probably dealing with a dividend stock. If it's low, no dividend, probably, not a dividend stock, it's all focused on the revenue. So from that, you probably get a lot of information straight away from there. And then after getting a brief insight of the company, what you're going to do is you're probably going to learn the fundamentals. So you're probably going to look, I like using Simple Wall Street at the moment for this, is you're probably going to check what revenue it is. When you look into the revenue, also look at the profit. How's the company doing? Is it going up in profit? Is it going down in profit? You get a good understanding of the company there, what's going on in the inside. You look at insiders buying, you get a feel of what's happening. If you see it's insiders selling out, you get a bit of a red flag there. If the insiders buying, positive sign as well right there. PE, look at the PE history, everything like that. So at Simple Wall Street, I would scan through what's going on with the company and get a good understanding from the company from that sort of side of it. If there's things that I like in there, then I will probably then go to the next stage and look at the earnings report. But generally, when I'm looking down the page, one thing that I will straight focus on is what's going on with the company with the earnings and revenue side of it. So even though we're looking future ahead, and that's where you'll probably get your 100% return, is you've got to understand where the future of the company is. If the revenue's historically been declining, I'm like, that's not great. So if the company's historically been increasing revenue and increasing profit, then that's pretty good. And then obviously I'm going to look at the forecast and see what other people think as well. If analysts see that it is forecast to be doing quite well in the future, then obviously that's a really positive sign from here. But obviously I'm not going off analyst opinion, I'm just taking their word. If it's got a good future by the analyst side of it, then that gives me a little bit more confidence to look into why this company is going to do really well. Because at the end of the day, the reason why you get 100% return of the company is really simple. It's all about, if the company goes up in revenue, then normally and profit, your share price goes up because more people buy in. Your shares go up in value because more people want to buy that company because that company is doing well. That's the sole. It's really easy investing. That's the whole principle of it, is just buying shares and selling them for more because the company's going really well in the future. That's why I say don't get caught on metrics. Metrics aren't important. Metrics are not why people are going to buy into the company. It's not why the share price is going to go up. It's not why the revenue is going to go up. It's not why the earnings are going to go up. Share prices go up because the company is doing well with revenue and profit, and that's why people buy into the company. It is that simple. Investing sometimes gets, and I'm here doing however long this video is, making it sound quite complicated myself, but investing is very simple. It's just buying something and selling it for more than what you bought it for, and that's it. And just judging where the company's going to go, revenue increase, profit increase, and why more people are buying into that company. And that's just how you make money in investing in general. So obviously those are the big things to take into consideration. Now I'm probably going to go into the earnings report. When I go into the earnings report, you can find this on the actual company's website. It'll probably say like things about the company. It'll talk about its outlook, where it sees the company going. Now, whether it goes into detail about why this company is going to be successful, you kind of have to put your own knowledge into there as well and do a little bit of research and also see some competitors as well. So for example, I bought into Pinterest not so long ago, looked into Pinterest and I listened to the earnings call, and basically the CEO said, we see profit and revenue exploding. The reason why is A, because we have a lot of international growth, B, our international growth isn't monetized, so we're going to start doing that in Q4, which should see us do really well. And from there on, we're going to have more users, more monetization, and then that should see our profit and revenue explode. And from my knowledge that I put into there, I thought Pinterest is a good platform. A lot of people are using it. There's a lot of growth on it, and I can back that up with what the CEO says. And I put both and both together and thought, so the company says it's going to do well with monetization, and with monetization it's going to make more revenue and profit. Agreed. And I also thought the platform is good. Competition wise, even though there's a lot of competition in the social media play, I thought this platform's unique. There's not another Pinterest out there, so it should do quite well. So I put two and two together and I thought, I like this company. I see that more people, when this revenue and the profit increases, more people will buy into this company, the shares will go up, and I'll make money from this stock. And that's another company that I bought into and thought I would get 100% return on. At the moment, not doing too bad. I think we're up like 80% on one in one portfolio on Pinterest, and that was a purchase that we made just over a year ago. And like I say, trying to get as many 100% returns in 2 to 5 years as you can, obviously is a great thing. You know, it's better to have not as many companies and make sure they're guaranteed 100% rather than, you know, spreading yourself too thin. But having quite a few of these different 100% returns and spreading yourselves out is probably the best thing to do, just to diverse your portfolio. And obviously, sometimes some of the companies will take a bit longer. Some will take 4 to 5 years. Sometimes will take 2 to 3 years. Sometimes the really good ones is that, you know, you get them home runs and you hit them, you know, before 2 year mark, which is obviously the big thing that really does help your portfolio. That's where you do start to notice a lot of gains when you do hit them before the 2 year mark. But in general, I do, you know, aim for the 2 to 5 year mark as where I would sell a lot of these companies that I do invest into. Now, one of the things that I see a lot of people do is they do all these first processes really well. You know, they do this, and then the end game is where they sometimes get a little bit caught up on, and they don't understand what to do on their end game. They don't have, when they're bought in, they don't set themselves a valuation of where the company will go, where they think the company will go, where they would sell out at. And whenever I buy into a stock, I always have an end game. I have a valuation where I go, I think in 2 years it could be this valuation, and at that valuation I think it's a fair price, and that's where I'd sell out. Now, sometimes, granted, I do change my valuations if I feel like something's changed in the company, and I think that there could be even more upside if I hold it for longer. So a prime example for this is Microsoft. I've been buying Microsoft for a very long time, and at one point I think I bought Microsoft $110, and I thought at $180 I'd sell out, and it's now up in the 200 range. But I look at Microsoft now and I think everything they've got in place is just going to send that stock price even higher, and more people are still going to buy in here. So I can sometimes adjust it that way, but sometimes I look at a company and I think, so for example, like iRobot, I feel like I looked at that company and I felt like, so it's, you know, 52-week highs is near $80, and this is more of a value play. So I see a company like iRobot, and I see that it was at, like, I think its 52-week high was like $82. It's completely sold off. Its PE normally at that range is about 30. It's now at 15. And I looked and I thought, it's at $40, $80, 52-week high, 100% upside. That would put its PE as well back to where it normally is as well. So how many people would want to go in after that point? Probably not that many. So I thought it's definitely undervalued because it's not normally at these valuations. But then I looked, and obviously I did a lot more information about how the company will do, if it will increase sales and all that. But this is kind of like just a trimmed down version. And I looked and I think, so that gives it 100% upside from here. So that's probably a fair target. It might go above there, but this is where investors were previously happy at, and that's where I sold out of the company. And sometimes that's how you do the valuation. Sometimes you got to factor in where the revenue is, what's happened in the stock chart previously. Growth companies are a little bit trickier because obviously your metrics kind of go out your window. But yeah, you just got to get an end valuation. And sometimes, like I say, if the company's doing well, you can always hold it, but you've got to have a point where you think this company is quite overvalued, and then you do sell out of it and take them profits. Because when you have a company that's up 100%, it's good having them profits on your screen. But if you have £200 and your company goes up £200 and it's worth £400, your value is still at £200. You know, if you then sell out at 400, you have £400, and then you can put that into a stock. 400 into 800, sell out. 800 into 1,600, sell out. And that's how you keep doing your money up. If you keep that money in your stock and it goes up 200% and you've got £400, if you were to sell it, the problem is that you can't actually use that equity until you sell it and you have it in your cash pile. So that's something you've also got to be careful of, is you can't use the equity you've gained until you've actually pulled it out of the market. Now, the thing is sometimes then you can lose even higher percentage, but the big thing is having that, you know, equity to then buy more companies and stocks. So, you know, that's why I sold Tesla. I looked at what I had and I thought, I can buy so much stocks with this cash now. You know, I've 250% my money here. I can buy so many companies, and that's what you got to look at, is that money goes on to make more money, and that makes more money, and that's where the circle carries on, and you see your portfolio go from 10,000 to 100,000 to 1,000,000, and that's how it carries on doing that big circle, and that's how you make the big massive gains overall. So you've got your game plan. Obviously, then you want to sell your stock, and then obviously you got your 100% profit, you made your profit, and with that money, you have more money to invest into the market to have a bigger position than what you did previously. So then you sell it, and then obviously after you've done that, you repeat this all again, and you repeat it. You go back, you pick a stock, search the company, think why it goes up 100%, take it out, you doubled your money again, and that's how you just keep getting that snowball effect of your money, and how you make even more money in the stock market, and you just carry on repeating this process. And like I say, as you get more and more experience, this kind of gets a bit more normal. You know what you're looking for. It comes a lot easier. You realize, you start to filter out, you know, a lot of the bad companies. I think when you start investing, as long as you can get to a rate where you're getting 7, 8 stocks right, and then you can get to 8 or 9 stocks right, then you start seeing big rewards. Obviously, 2 to 5 years is what we're looking at, but the best way, if you can, is obviously if you do hit a few before the 2-year mark, which is definitely more down to luck than actually skill. But sometimes if you do pick the right companies, you will get it. That obviously is what helps your portfolio huge as well. So that's hopefully giving you some insight on how to get 100% return on the stock. And I have no idea how long this video has gone on for, but I'll check in a minute. But I hope you enjoyed the video and you've got some tips from this video anyway. As always, guys, remember, if you can like the video for all of it, subscribe if you haven't, that'd be absolutely amazing. And I'll see you in the next video.